On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning, all. Hope you've had a good week. That's another one down, and it was a very good one for most share markets, actually. We had the S&P 500 in the US up 2.2%, so the index has risen 7.6% so far this month during November, and that sees it on track to have its best month in more than a year. You've got to go back to October last year to find a month where things were stronger. So it's been a very, very good performance over the last few weeks. European shares also very strong, up 2.8% last week. The UK market 2% higher, and the Aussie market, the ASX 200, rose 1.4%. The NZX 50 here in New Zealand was a little more subdued, but it still rose 0.3%. That's the third week in a row of gains, and our market has rallied 3.9% this month. So we're on track for our best performance since January. Interest rates continued to come down last week. We had the US 10-year Treasury yield fall from 4.65% to 4.44%. So it's almost 60 basis points below the 16-year high of just over 5% that we saw a month ago. So we were at the highest levels since 2007 about a month ago, just over 5%. And in that short space of time, the US 10-year yield has come down from just over 5 to around 4.4. So quite a big move. Few reasons for that. We've seen softer US inflation figures. We'll talk about that shortly. Last week, we also had initial jobless claims, which come out weekly. They spiked to the highest levels since August, and we saw continuing jobless claims rise to the highest level since late 2021. We've also seen oil prices come down. US crude, WTI crude, down about 6% this month. And it's sitting at 75, 76 US dollars a barrel, but it fell as low as $73, I think, on the Thursday trading session last week. And that's a 4-month low. So what you've seen is markets not only move to price in no more Federal Reserve rate hikes. We've got one more meeting to come next month. Markets don't see a change there, but markets are now pricing in almost 100 basis points of rate cuts from the Fed during 2024, during the calendar year. So at the moment, market pricing points to the Fed funds rate being close to an entire 1% lower pretty much this time next year. So it's been a big shift from where we were at a couple of months ago, where everyone was talking about the higher for longer theme. We've seen similar moves here in New Zealand on the interest rate front. Our local 5-year swap rate, which is a wholesale rate, and it's one of the building blocks for what you see in your mortgage rates and your fixed income bond yields and so forth. That 5-year swap rate fell last week from 4.9 to 4.65. So we're at the lowest level since July, a few months back, and we've seen that rate actually fall 74 basis points from where it was last month. Last month it got as high as 5.39, which was a 13-year high, highest since 2010. And it's come right back from almost 5.4 to about 4.6. So a hefty move here in New Zealand as well. And that obviously saw bond prices perform well because interest rates are coming down, and those two things move in opposite directions of each other. The NZX investment grade corporate bond index, which is a good proxy for what most private investors would own in terms of their fixed income portfolios. Private investors tend to focus on corporate bonds rather than government bonds, and this index is up 5.1% in 2023. So that's a combination of capital growth and the income received. So it's a total return index, but 5.1%. That's a great return. Certainly better than last year. Certainly better than the year before, and it certainly sees bonds performing better in 2023 than New Zealand shares or New Zealand houses. So in terms of the New Zealand spectrum of domestic assets you can own, fixed income has been the place to be this year. And just like the Fed, we've seen market pricing for what the Reserve Bank will do change quite dramatically over the last little while on the back of some of those indicators and evidence of inflation coming down, labour market starting to ease up a little bit. Markets now see the official cash rate as having peaked. Before there was a bit of speculation there might be another hike in it, and markets were pricing that in partially. Now that is not in the pricing curve at all. So in the eyes of financial markets, the official cash rate is at its peak, 5.5%. We've got a meeting next week, I think, actually, which will be the last one of the year, and then there's a break until February. I've had the view for a little while now that we're at the top, and markets have come round to that sort of way of thinking. So we'll see how things develop over the next few months. But pricing for next year also points to cuts. So just like the Fed, market pricing suggests that we'll see 3 or 4 interest rate cuts, 0.25% ones. Similar story here in New Zealand. The market is pricing in 3 0.25% cuts for next year. So, roughly 75 basis points of easing over 2024. And all that could change on a dime. All it would take would be one comment from a central banker, or a hotter than expected inflation report, or some stronger economic data, or who knows what. So take all this with a grain of salt. It's just interesting to see how aggressively the rhetoric has shifted of late. Key events last week. Well, we had the US inflation figures for October. That was the biggest release, and markets did react to it. That was one of the reasons we saw people erase bets for any further hikes from the Fed. Headline inflation unchanged in October, so no increase. It was flat for the month. That's the lowest in 15 months, and it's less than what people were expecting. Core inflation for the month also a little softer than expected. So in terms of the annual inflation rates, the annual headline inflation rate came down to 3.2. That's the lowest we've seen since March 2021. And the core inflation rate came down to 4.0. That's the lowest since September 2021. So both of those well off the peak and coming back to territory where the Fed won't be comfortable, but it's definitely heading that way. We had some Chinese economic indicators out last week, and a little bit mixed, to be honest. Retail sales, industrial production, better than expected in October. That's good. Fixed asset investment, okay, but a little below forecasts. The property sector definitely looking like it's still a drag. Investment into that space fell by more than people were expecting. So all in all, it was probably a little subdued, albeit better than expected in places. However, important to note that where we did see improvements, that was largely due to base effects. And base effects means because of it's done sort of on a 12 months comparison. If you had a particularly weak period a year ago, then that can sort of flatter the data that you're seeing today, or the opposite if you're sort of comparing to quite a strong period. And in this case, it was flattering the data. So I think you've still got a few concerns out of China. Speaking of China, the big political event last week was the meeting between US President Joe Biden and his counterpart from China, Xi Jinping. They met in San Francisco ahead of the APEC summit. I think that was Wednesday last week, and this was closely watched. It was the Chinese leader's first visit to the US since 2017. And there were some good headlines that came out of it. They agreed to restart talks between the military, a few other initiatives, generally making the effort to reduce some of those tensions that have emerged over the last 12 months or so. And I think there are incentives on both sides to do that. Both their economies, the US is much stronger at the moment, but it is likely to slow next year, and some people think there might be a recession on the cards. The Chinese economy obviously has struggled this year, and it's probably going to continue to, muddle through at best. So those things matter because there's a US election next year, and recessions don't do any favors to the incumbent president. So there's risk around Biden's election campaign if the economy is doing it tough. And for Xi, it's really just a matter of social risks and social stability. So both of them probably have a bit of an incentive to not rock the boat. Thinking about some of the things they talked about, I think it's important to note that we should maybe take some of Biden's comments or promises or assurances with a bit of a grain of salt. He's not going to be around as long as Xi. For one, he's a lot older. Biden's 80. Xi Jinping is only 70. And Biden's term in power could end much sooner. We've got the US election in November next year. If he doesn't get back in, he'll be out in January 2025, which means he's only got another 12 months or so, just a little bit longer than that. If he gets re-elected, then he'll be there until early 2029, another 4 years. They've obviously got the 4-year terms. Whereas Xi Jinping, he's expected to reign until at least 2032. So, Biden, maybe it's early 25, maybe it's early 29, but Xi, he's going to be there into the 2030s. So that's something that is important to note. I think the bigger news last week in terms of the US-China relationship was came in terms of Taiwan. They've got an election coming up in January. I want to say January the 13th. I might have that date wrong, but it's early in the year, and this will be really key in terms of geopolitical risks and tensions. And what happened that was important last week is the two leading opposition candidates for the Taiwanese presidency, and I can't remember the names of the parties. I can remember the acronyms. You've got the KMT and the TPP party. That one's the Taiwan People's Party, I think. But basically, these two leading opposition candidates agreed to join forces and run on a single ticket and as a coalition in the elections. And that's really important because the current regime is very pro-independence, and they've been in place since 2016. And I think they'll be going for their third term in office, won't they? Yeah, this will be them going for their third term in office. So they've been there since 2016. They're pro-independence, whereas these two that have chosen to join forces are pro-mainland, pro-China. And because they're joining forces, they're much stronger. And that probably takes the election outcome much closer to a 50-50, whereas before you would have said there's a good chance that this current government will be re-elected. So now, long story short, you've got a much higher chance of a change of government in Taiwan in January, and that change would mean you've got a pro-China government in place. And if that happens, the risk of any conflict falls sharply, obviously, because China will be able to make much more headway in terms of integrating with Taiwan without needing to use force or additional threats. So I think that was the real news last week, and would be a good thing from a markets perspective, from a geopolitical perspective, because that's something that everyone asks about, everyone talks about. What's the real tail risk out there? It's a Chinese invasion of Taiwan or some conflict that emerges between them and the US. But anything that de-escalates that situation would be a real positive. So that was interesting. On the local front, we had the housing market report. This was probably the only key thing that came out of New Zealand for October. Further evidence of an improving market, prices continuing to rebound, activity still pretty solid. You'd expect that to improve once the election is finalised, once we get sort of confirmation about things like the Bright Line test, maybe, applying to a shorter period. And what's the other one? Interest deductibility. So we're waiting for those bits and pieces. Plus, just the better weather tends to, move a few people off the sidelines, as does a stronger market. You're more inclined to list your house if the market is healthy rather than when it's not. So my view is that house prices will still continue to drift higher. What we saw during the month of October was national house prices rose 1.1%. That's the fifth consecutive monthly gain, the strongest gain since November 2021, actually, and that was the peak of the market. So prices have now rebounded 4.1% in those 5 months. They fell 18, just over 18 from the top of the market in late 2021 to May of this year. So down 18 and sort of up 4. They're still much higher than they were pre-COVID, so hardly affordable. So don't get excited about prices really running away on you. I think they will continue to push higher over the next 12 months, 18 months, but we won't be going back to those days of the double-digit house price gains, I would think. Looking ahead to this week and on the global front, I think it'll be the flash PMIs for November that will be the key release in terms of economic releases, and we'll be watching to see whether the manufacturing sector rebounds further, whether the services sector continues to weaken. They'll come out at different times to usual. They usually sort of all come out on the same day, but this time we've got the Aussie PMI at 11 o'clock on Thursday, the UK and Europe that evening, and then the Japanese PMI doesn't come out till Friday afternoon, and then the US PMI doesn't come out until overnight on Friday. I think that might be because we've got a holiday shortened week in the US. It's Thanksgiving, obviously, this week. So the markets will be closed on Thursday for Thanksgiving, and they reopen on Friday, but it's a short day. So there's an early close the day after Thanksgiving, the Friday, and equity markets in the US will close at 1 o'clock US time. Bond markets close at 2 o'clock. So you'd imagine it'll be pretty quiet, and there won't be a lot of market action. It's essentially a 4-day weekend, I suspect, for many people. It is the unofficial start of the Christmas holiday season, shopping season, Black Friday, the day after Thanksgiving. So that's very much a US thing, but it's becoming increasingly relevant for us here in New Zealand. You're starting to see all the ads for Black Friday sales come through thick and fast. So the flash PMIs late in the week. In New Zealand, we will have retail sales for the September quarter. These are out on Friday morning, just a bit of a pulse check of the domestic consumer. They were pretty soft in the June quarter. I think they're pretty soft in the March quarter as well, actually, and the December quarter. So, yeah, interesting. If they're down again, as people are expecting in terms of volumes, you will have seen 4 quarters in a row, which is very unusual outside of recession. But we'll be watching that on Friday morning. Also got a dairy auction early on Wednesday morning, and we obviously had a big decline in prices for the bulk of last year, and then for the first 7 or 8 months of this year, as prices slumped almost 50% from the 15-year highs we saw last March, and we've had a rebound since then of 16 or 17% since mid-August. So hoping for some stability or even some improvement on that front. Obviously also watching for political news with National Act in New Zealand First in the depths of coalition talks. So who knows when we'll get some confirmation of what the government officially looks like. More importantly, we want to see which policies will survive those coalition talks, and whether you'll see any of them sort of watered down. They do have a few things in common, so there will be some policies that will definitely come through. If I had to guess, I would say you probably will see income tax brackets change. They all seem to believe that is a fair thing to do, and it is. Interest deductibility for residential property investments set to be reinstated. I would say that's definitely coming. Broader tax relief is a tough one. It's a flagship policy for National. They've really hung their hat on it. It's on the one hand, it's hard to see them seeing that as anything but a bottom line, because they've talked very strongly and campaigned very strongly on that. But on the other hand, it's also quite hard to see ACT and New Zealand First agreeing with significant tax relief for a range of reasons. So I suspect that is a big area of debate, and maybe it won't be able to. Maybe National won't sort of get their way, at least in the same shape, form, and quantum. You won't get a CGT, you won't get a wealth tax. So anyone who is still worrying about those sorts of things, you're not going to get it from these three. And one would think that you'd see movement on the clean car discount and the Auckland regional fuel tax as well. There seems to be consensus there, but yeah, we'll be looking for confirmation from the new government about sort of which policies will remain and which ones won't. Across the Tasman, we have the Reserve Bank of Australia minutes from the November meeting. These are out on Tuesday, and Michelle Bullock, the RBA governor, will also address a dinner on Wednesday night, the Australian Business Economists annual dinner, so that will be interesting. There's one more RBA meeting to come this year, and that will be in the first week of December. So they obviously came off the sidelines at the last meeting in earlier this month, Melbourne Cup Day, and raised interest rates. Will they do anything more? Quite possibly. Quite possibly. I'm not sure that it'll happen at this final meeting of the year, though. I suspect they might wait and see, and it might be something for February, March, May next year. So those minutes will be closely watched across the Tasman. Japanese inflation worth a mention as well. I don't talk about sort of the Japanese economy as much as I probably should, but it's quite interesting where they're at the moment. They've got their national CPI out on Thursday, and inflation for a long time in Japan was very low. They're actually flirting with deflation, which is why they've had to have very low interest rates, lots of monetary stimulus, negative interest rates, in fact, which is what they've still got. But core inflation in Japan recently hit 4% for the first time since 1981. And you've got headline inflation above 3%, which is, above target and, somewhere where it hasn't been for many, many years. So Japan is worth watching because, in a central banking sense, they're kind of the last man standing. Still doing a lot of stimulus. Still got negative interest rates. Even the Europeans and everyone else has sort of moved to something that looks a lot more normal. So the Bank of Japan is expected to sort of drop some of those aggressive policies over the next 12 months or so, and start moving interest rates out of negative territory, and a lot of it does come back to where inflation is sitting. So that is something that might continue to get more attention than it has in the past, just because of where it's moved to. On the corporate front, there is quite a bit going on here in New Zealand. A few more results to come. Oceania Healthcare on Wednesday. We have results from Goodman Property Trust, My Food Bag, Pacific Edge, Raycon, and Tower, all on Thursday. A couple of AGMs, Delegate and the Warehouse. Across the Tasman, not a whole lot of results, but a few interesting AGMs that are worth watching. AGL Energy, BlueScope Steel, Fortescue Metals, Downer, Medibank, and then internationally, not a lot, but NVIDIA is one of the few companies reporting. So while in terms of quantity, there's not a lot of results to come, but in terms of relevance, NVIDIA is obviously a massive one. That is the real AI poster child, and it's had a spectacular run this year. So that one will be worth watching. We'll obviously be keeping a close eye on the guidance and what they see ahead. You'd have to think it's probably going to be a strong result, wouldn't you? Even though the share price is probably pointing, well, the bar is set high because of where the share price is and how it's performed. I would not be betting against it. I suspect it will meet those high expectations that the market has for it. So that's where we're at. Plenty going on as always. Markets are in good heart, and November is living up to its name as a very strong month for investors. not just share investors, but also bond investors, because those interest rates that have been coming down have been seeing some great performance come out of conservative assets too. So, whether you're in bonds, whether you're in equities, you're probably feeling quite good about what you're seeing out there at the moment. So let's hope that continues. We'd all like a solid finish to what has been a fairly difficult and volatile year for the most part. All right, thanks team. Thanks for listening. We'll talk again soon.